In the background of every economy lies a hidden force. It's why interest rates stabilize or destabilize the world. There is a price that affects nearly every economic decision. This price influences whether people borrow or save. It shapes whether businesses expand or contract. It determines how assets are valued. It affects the flow of money across borders. This price is not fixed. It changes constantly in response to conditions. Sometimes it rises. Sometimes it falls. The movements create ripples that spread throughout economies. Most people encounter this price regularly. It appears on loan documents. It shows up in savings account statements. It influences mortgage payments and credit card bills. Yet few consider how deeply it shapes economic outcomes. The price operates through mechanisms that remain largely invisible. Changes in this price trigger chains of effects. Each effect influences others. The chains extend through time and across systems. When the price is low, certain behaviors become more attractive. Borrowing becomes cheaper. Saving generates smaller returns. Spending appears more appealing than waiting. Investment in projects with distant payoffs becomes viable. When the price is high, the opposite patterns emerge. Borrowing becomes expensive. Saving offers better returns. Waiting appears wiser than spending now. Only projects with quick payoffs seem worthwhile. These behavioral shifts accumulate across millions of individual decisions. The aggregate effect shapes overall economic activity. Growth accelerates or slows. Employment rises or falls. Prices increase or stabilize. The price thus serves as a lever affecting the entire economy. Small movements in the price can produce large effects. The leverage makes the price powerful. It also makes the price potentially destabilizing. Understanding how this works requires looking at connections. The price connects present to future. It links savers to borrowers. It ties domestic economies to foreign economies. It binds financial markets to real economic activity. These connections create a web of relationships. Changes anywhere in the web affect conditions everywhere else. The interconnection means the price's effects are never isolated. They always spread. The spreading happens through multiple channels. Some channels are direct and obvious. Others are indirect and subtle. All operate simultaneously. One channel runs through borrowing decisions. When the price falls, more borrowing occurs. The borrowed funds get spent. The spending becomes someone else's income. The income supports further spending. Another channel operates through asset values. When the price falls, future income streams become more valuable in present terms. Assets that generate future income rise in price. Rising asset prices create wealth effects that influence behavior. A third channel works through currency values. When the price in one country differs from prices in other countries, capital flows respond. Money moves to where returns are better. The flows affect exchange rates. Exchange rates influence trade and investment patterns. These channels interact with each other. Borrowing affects asset prices. Asset prices influence currency value. Currency movements alter borrowing costs for international transactions. The interactions create complexity. The complexity makes outcomes difficult to predict. Small changes in the price can cascade in unexpected ways. Sometimes the effects are stabilizing. Sometimes they are destabilizing. The difference depends on circumstances. Stability occurs when the price helps balance economic forces. If the economy is overheating, a higher price can cool it. If the economy is sluggish, a lower price can stimulate it. The price serves as a thermostat regulating temperature. Destabilization occurs when the price amplifies imbalances. If the price stays too low for too long, excessive borrowing may occur. If it rises too sharply, widespread defaults may follow. The price can swing from helpful to harmful. The line between stability and instability is not always clear. What seems like appropriate pricing in the short term may create problems longer term. What appears stabilizing from one perspective may seem destabilizing from another. This ambiguity makes managing the price challenging. Those who try to influence it face difficult trade-offs. Actions that solve one problem may create another. Timing matters greatly, but is hard to judge correctly. The price is not set by a single authority making a simple decision. It emerges from the interaction of many forces. Supply and demand play roles. Policy decisions influence outcomes. Expectations about the future affect present conditions. The interplay of these forces determines where the price settles at any given moment. The settlement is temporary. Conditions change continuously. The price adjusts in response. Some of the forces are visible and measurable. Economic data reveals certain conditions. Policy announcements indicate official intentions. Market prices reflect collective assessments. Other forces are invisible and hard to quantify. Confidence and fear move markets but cannot be measured precisely. Expectations about distant futures shape present decisions but remain uncertain. Cultural attitudes toward borrowing and saving vary across societies but defy easy categorization. The combination of visible and invisible forces creates a system that is partly predictable and partly chaotic. Patterns exist and can be observed, but surprises occur regularly. The system is orderly enough to function, but disorderly enough to challenge understanding. This dual nature explains why the price can both stabilize and destabilize. When conditions are favorable and expectations are aligned, the price tends to support stability. When conditions are strained or expectations diverge, the price may amplify instability. The transition from one state to another can happen gradually or suddenly. Sometimes warning signs appear well in advance. Sometimes changes come without apparent warning. The unpredictability is inherent to the system. Yet despite unpredictability in specifics, certain general patterns recur. Periods of low prices tend to encourage expansion. Expansion eventually creates pressures that push prices higher. Higher prices eventually slow activity. Slowing creates conditions that push prices lower. The cycle repeats. These cycles are not mechanical or precise. Each one differs in length and amplitude. Each occurs in unique circumstances. But the general pattern of rise and fall persists. The persistence suggests that the price is part of larger economic rhythm. It does not operate independently, but participates in broader dynamics. Understanding its role requires seeing it as element within a larger system, rather than as isolated phenomenon. The larger system includes production and consumption. It includes employment and income. It includes innovation and competition. It includes confidence and expectations. The price interacts with all these elements. The interactions create feedback loops. Changes in the price affect economic activity. Changes in activity affect the price. The loops can be reinforcing or dampening. They shape how economies evolve over time. Reinforcing loops amplify changes. A falling price encourages borrowing. More borrowing boosts activity. Stronger activity may justify even lower prices. The cycle accelerates. Dampening loops moderate changes. A falling price encourages borrowing. But increased borrowing eventually creates demand for funds that pushes the price back up. The correction prevents runaway acceleration. Whether loops reinforce or dampen depends on many factors. The state of the economy matters. The availability of resources matters. The behavior of other prices matters. The expectations of participants matter. All these factors are themselves influenced by the price. The circular causation makes the system complex. Effects become causes. Causes produce new effects. The chains of influence extend indefinitely. This complexity is what gives the price its power to stabilize or destabilize. In some configuration, the complexity produces stability through self-correction. In other configurations, it produces instability through self-reinforcement. Understanding which configuration exists at any moment is difficult. The system does not announce its state clearly. Observers must interpret ambiguous signals. Different interpretations lead to different actions. The actions themselves affect outcomes. The observer effect means the system is not purely objective. Human perception and interpretation shape what happens. Collective beliefs can become self-fulfilling. If everyone expects the price to rise, behaviors change in ways that cause it to rise. This psychological dimension adds another layer to the system. Beyond objective economic forces lie subjective assessments and expectations. Both influence the price and its effects. The interweaving of objective and subjective elements makes the price uniquely influential. It operates at the intersection of mathematics and psychology. It reflects both calculable realities and incalculable sentiments. What is this price that operates so powerfully yet invisibly? What determines its level and movements? How did it come to play such a central role in economic systems? These questions lead deeper into understanding. The price that shapes economic stability and instability is the interest rate. Interest rates represent the cost of borrowing money or the return from lending money. They measure the compensation required for deferring consumption or taking on risk. At the most basic level, an interest rate is a ratio. It compares an additional payment to an initial amount. The ratio expresses how much extra must be paid beyond what was borrowed, or how much extra will be received beyond what was lent. The ratio is typically expressed in relation to time. A rate applies over a period, usually a year. A higher rate means more compensation. A lower rate means less compensation. Interest rates exist because people value having resources now more than having them later. This time preference is fundamental to economic behavior. People generally prefer earlier consumption to later consumption. The preference creates demand for ways to bring future resources into the present. Borrowing allows this by providing resources now in exchange for repayment later. But borrowers must compensate lenders for waiting. The compensation is interest. Simultaneously, some people have resources now but do not need to use them immediately. They are willing to defer use in exchange for additional resources later. Lending allows this by providing resources to others now and receiving repayment with interest later. Interest rates coordinate these opposing preferences. They make mutually beneficial exchanges possible between those who want resources sooner and those willing to wait. The rate adjusts to balance the desires of borrowers and lenders. When many people want to borrow and few want to lend, rates rise. Higher rates make lending more attractive and borrowing less attractive. The adjustment brings supply and demand into alignment. When many want to lend and few want to borrow, rates fall. Lower rates make borrowing more attractive and lending less attractive. Again, the adjustment creates balance. This equilibrating function is one way interest rates stabilize economies. They provide feedback that moderates extremes. They prevent unlimited borrowing or unlimited saving. But interest rates involve more than simple time preference. They also incorporate risk compensation. Different borrowers present different levels of risk. Some are highly reliable and almost certain to repay. Others are less reliable and may default. Lenders demand higher rates from riskier borrowers. The risk premium compensates lenders for the possibility of non-repayment. It increases the expected return to account for potential losses. The adjustment makes lending to risky borrowers worthwhile for lenders. Risk assessment introduces complexity into interest rate determination. Rates differ across borrowers based on perceived risk. They differ across types of loans based on security and terms. They differ over time as risk perceptions change. The variation in rates creates a structure rather than a single rate. Many different rates exist simultaneously. They relate to each other but move somewhat independently. Short-term rates differ from long-term rates. Rates for secured loans differ from rates for unsecured loans. Rates for borrowers with excellent credit differ from rates for borrowers with poor credit. This rate structure reflects the diverse nature of borrowing and lending. Different circumstances call for different compensation. The structure provides fine-grained pricing of time and risk. Interest rates also reflect expectations about future conditions. If lenders expect inflation, they demand higher rates to maintain real purchasing power. If borrowers expect income growth, they accept higher rates knowing repayment will be easier. Expectations are embedded in current rates. Today's rate reflects not just current conditions, but also beliefs about future conditions. This forward-looking aspect makes rates sensitive to information and sentiment. News that changes expectations changes rates immediately. The adjustment happens before underlying conditions actually change. Rates incorporate anticipated futures into present prices. This anticipatory nature is another source of both stability and instability. When expectations are accurate and stable, rates help coordinate future-oriented decisions efficiently. When expectations are volatile or mistaken, rates can mislead and amplify problems. Interest rates exist in the context of monetary system. Central banks influence short-term rates through policy operations. They adjust the rates they charge banks for borrowing. They affect the rates banks receive for holding reserves. These policy rates serve as anchors for other rates. Changes in policy rates ripple through the entire rate structure. Market rates adjust in response to policy changes. The transmission from policy rates to market rates is imperfect and variable. Sometimes it works quickly and fully. Sometimes it works slowly and partially. The effectiveness depends on financial conditions and expectations. Through this transmission mechanism, central banks attempt to influence economic activity. Lower policy rates aim to stimulate by making credit cheaper. Higher policy rates aim to restrain by making credit more expensive. The mechanism makes interest rates a key tool of economic management. But market forces also shape rates independently of policy. Supply and demand for credit move rates. International capital flows affect domestic rates. Changes in risk perceptions alter rate structures. The interplay between policy influence and market forces determines actual rates. Sometimes they work in the same direction. Sometimes they work against each other. The interaction creates complexity in rate determination. Interest rates also connect to inflation. Inflation erodes the purchasing power of money over time. Lenders require rates high enough to compensate for this erosion. The real interest rate is the nominal rate minus expected inflation. Real rates measure true time preference and risk compensation. Nominal rates include an inflation component that simply maintains purchasing power. The distinction matters because real rates affect real economic decisions. When real rates are positive, saving provides genuine returns. When real rates are negative, saving loses purchasing power even as nominal balances grow. The real rate determines incentives for saving and borrowing. Central banks target inflation partly to influence real rates. By controlling inflation, they affect the relationship between nominal and real rates. This gives them indirect influence over real borrowing costs. Interest rates serve multiple functions simultaneously. They price time preference. They price risk. They incorporate expectations. They transmit policy. They connect to inflation. These multiple functions mean rates carry substantial information. They aggregate many individual assessments and decisions. They reflect collective judgments about present conditions and future prospects. The informational content makes rates valuable signals. Rising rates suggest tightening conditions or changing expectations. Falling rates suggest easing conditions or shifting outlook. Observing rates provides insight into economic state. But the signals are not always clear or correct. Rates can be distorted by temporary factors. They can reflect mistaken expectations. They can be influenced by manipulation. Understanding what rates reveal requires interpretation. The same rate level might mean different things in different contexts. Rate movements must be assessed against broader conditions. Interest rates exist because economies need mechanisms to allocate resources across time. Without rates, coordinating saving and borrowing would be difficult. Rates provide the price signals that make intertemporal coordination possible. They solve the problem of matching those with current surplus to those with current needs. They create incentives for both parties to participate. They enable mutually beneficial exchanges across time. But in solving this problem, rates gain power to influence economic stability. Their movements affect borrowing, spending, saving, and investment. Through these effects, they shape aggregate activity and employment. The power means rates can stabilize when used wisely. Appropriate rate adjustments can moderate economic fluctuations. They can prevent overheating or excessive cooling. But the same power means rates can destabilize when mismanaged. Inappropriate rates can amplify problems. They can trigger booms and busts. They can create financial fragility. Whether rates stabilize or destabilize depends on how they are determined and how they respond to conditions. This brings attention to the processes through which rates are formed. Interest rates emerge from the interaction of many forces and decisions. No single process determines all rates. Different rates form through different mechanisms. The most fundamental rates form through direct borrowing and lending between parties. Two people might agree on a loan between themselves. They negotiate terms, including the interest rate. The rate they agree on reflects their individual circumstances and preferences. Such direct lending was how interest rates first emerged historically. When one person lent to another, they expected compensation for parting with their money temporarily. The compensation was interest. The rate in these direct transactions depended on negotiating power and alternatives. If borrowers had few options, lenders could demand high rates. If lenders competed for borrowers, rates fell. As economies developed, institutions emerged to intermediate between savers and borrowers. Banks accepted deposits and made loans. They charged borrowers higher rates than they paid depositors. The spread covered costs and provided profit. Banks had to determine what rates to offer depositors and charge borrowers. These decisions were informed by several factors. They observed what other banks were offering and charging. Competition prevented any single bank from straying too far from prevailing rates. If one bank offered much lower deposit rates, depositors would move money elsewhere. If it charged much higher loan rates, borrowers would go to other banks. They assessed their own costs and desired profit margins. Deposit rates had to be low enough and loan rates high enough to cover expenses and generate returns. They evaluated the risk of different borrowers. Riskier loans required higher rates to compensate for expected losses. The assessment of risk involved examining borrower characteristics and loan features. Through these considerations, individual banks set their rates. The collective effect of all banks' decisions determined the overall structure of deposit and loan rates in the economy. But banks themselves needed to borrow from each other at times. A bank with surplus reserves might lend overnight to a bank needing reserves. The rate on these interbank loans emerged from supply and demand among banks. When reserves were plentiful, interbank rates fell. When reserves were scarce, rates rose. The daily negotiation among banks determined short-term interbank rates. Central banks entered this process by affecting reserve availability. They could add reserves through various operations. They could drain reserves through opposite actions. By managing reserve quantities, central banks influenced interbank rates. More reserves pushed rates down. Fewer reserves pushed rates up. Over time, central banks developed more direct rate-setting tools. They established rates they would charge for lending reserves to banks. They set rates they would pay on reserves banks held with them. These official rates created floors and ceilings for market rates. Banks would not lend to each other at rates below what the central bank paid. Banks would not borrow from each other at rates above what the central bank charged. The result was that market rates stayed within a range determined by central bank rates. By adjusting its rates, the central bank controlled the range of market rates. This gave central banks powerful influence over short-term interest rates. Their policy decisions largely determined where short-term rates settled. But longer-term rates were less directly controlled. These rates formed through bond market trading. Governments issued bonds to finance their activities. The bonds promised specific future payments to holders. Investors bought and sold these bonds in markets. The price of a bond determined its effective interest rate. A lower price meant a higher rate. A higher price meant a lower rate. The relationship was mathematical and precise. Bond prices fluctuated based on supply and demand. When investors expected stronger economic growth, they anticipated inflation and higher future rates. They sold bonds, pushing prices down and rates up. When investors expected weaker growth, they anticipated low inflation and rates. They bought bonds, pushing prices up and rates down. Central bank policy influenced these expectations. Announcements about future policy intentions affected how investors viewed the outlook. This gave central banks indirect influence over longer-term rates through expectations management. But market forces also drove long-term rates independently. Global capital flows affected demand for bonds. Changes in government borrowing affected supply. Shifts in risk tolerance influenced investor preferences. The formation of long-term rates thus involved both policy influence and market determination. Central banks shaped expectations but did not dictate outcomes. Market participants made independent judgments that affected prices and rates. Credit markets added another dimension to rate formation. Companies issued bonds to raise funds. The rates on corporate bonds depended on company-specific risk. Credit rating agencies assessed company financial strength. They assigned ratings indicating likelihood of repayment. Higher ratings meant lower perceived risk and lower required rates. Lower ratings meant higher risk and higher rates. The spread between corporate bond rates and government bond rates reflected credit risk. The spread widened when risk concerns increased. It narrowed when confidence improved. Changes in credit spreads indicated shifting risk perceptions. Widening spreads suggested growing concern. Narrowing spreads suggested improving sentiment. The movements provided information about economic conditions. International factors also influenced rate formation. Capital could flow between countries seeking better returns. If rates were higher in one country than another, capital tended to move toward the higher rates. The capital flows affected exchange rates. Demand for a currency to invest in that country's assets pushed the currency value up. Currency movements, in turn, affected trade and economic conditions. Central banks sometimes coordinated their policies across countries. Similar rate movements in major economies prevented destabilizing capital flows. Coordination helped maintain stability in international financial markets. The formation of interest rates occurred at multiple levels simultaneously. Individual loan rates were negotiated between specific parties. Bank rates emerged from institutional policies and competitive pressures. Interbank rates formed through daily market activity, guided by central bank operations. Long-term rates developed through bond market trading, influenced by expectations. Credit spreads adjusted based on risk assessments. International rate differences drove capital flows. All these processes interacted. Changes in policy rates affected bank lending rates. Bank rate changes influenced borrowing and economic activity. Activity changes affected inflation expectations. Expectation changes moved long-term rates. Long-term rate movements influenced current economic decisions. The circular interconnection meant rate formation was a continuous dynamic process rather than a single determination. Rates constantly adjusted in response to changing conditions and information. No single authority controlled all aspects of the process. Central banks had powerful influence over short-term rates. But market forces shaped longer-term rates and credit spreads. The interaction produced outcomes that no single party fully determined. This distributed formation process had advantages and disadvantages. It incorporated information from many sources. It allowed adaptation to local conditions. It provided flexibility and resilience. But it also created potential for miscoordination. Different parts of the rate structure could send conflicting signals. Market expectations could diverge from policy intentions. International flows could overwhelm domestic policy efforts. The formation process also changed over time. Financial innovation created new instruments and markets. Technology enabled faster information processing and trading. Regulation altered how certain markets operated. Each change modified how rates formed. New derivatives allowed more sophisticated risk management and speculation. Electronic trading increased market efficiency and speed. Regulatory constraints affected who could participate and how. The evolution meant rate formation mechanisms in earlier eras differed from current mechanisms. What worked in one period might not work in another. Understanding required recognizing the historical and institutional context. Throughout all this complexity, certain fundamental forces remained constant. Supply and demand for funds influenced rates. Time preferences affected willingness to save or borrow. Risk perceptions adjusted required returns. Expectations about futures shaped present rates. These fundamental forces operated through whatever institutional mechanisms existed. The mechanisms channeled and shaped the forces, but did not eliminate them. Interest rate formation was thus both timeless in its fundamentals and time-specific in its mechanisms. The basic economic forces persisted, but how they manifested depended on evolving financial structures. Understanding rate formation means recognizing both the constants and the variables. The constants explain why rates exist and what they reflect. The variables explain how rates emerge in particular contexts. With this understanding of formation, attention can turn to how rates function once formed. How do they influence economic activity day to day? What chains of effect follow from rate changes? Interest rates function by influencing decisions about spending, saving, borrowing, and investing. These influences ripple through the economy continuously. Consider a household deciding whether to purchase something expensive. If the purchase requires borrowing, the interest rate affects the total cost. Higher rates mean higher monthly payments. Higher payments may make the purchase unaffordable or less attractive. Lower rates reduce borrowing costs. The same monthly payment can finance a larger purchase, or the same purchase amount costs less per month. The improved affordability encourages purchasing. Multiply this single household decision by millions of households. Collectively, rate-influenced purchase decisions affect demand for goods. Demand affects production and employment. The chain of effects extends from the interest rate through individual choices to aggregate activity. The same logic applies to business investment decisions. Companies borrow to finance expansion, equipment, or research. The interest rate is part of the cost calculation. When rates are low, more projects meet the profitability threshold. Expected returns need only exceed a lower hurdle rate. More investment occurs. When rates are high, only the most profitable projects proceed. The hurdle rate is higher. Marginal projects are abandoned or delayed. Investment declines. Investment affects capital accumulation and productivity. More investment builds capacity and improves efficiency. This supports economic growth over time. Less investment means slower capacity expansion. Growth potential diminishes. Future income is lower than it might have been. The interest rate thus influences not just current activity, but future productive capacity. Through investment decisions, rates affect long-term economic trajectory. Saving decisions also respond to rates. Higher rates make saving more rewarding. Each dollar saved generates more future income. This encourages deferring consumption. Lower rates reduce returns to saving. The incentive to defer consumption weakens. Spending now becomes relatively more attractive than saving for later. The balance between spending and saving in the aggregate affects demand. More saving means less current spending. Less current spending reduces immediate economic activity but builds resources for future investment. More spending means less saving. Current activity stays stronger but fewer resources accumulate for future use. Interest rates help balance these competing considerations. They provide signals about whether the economy needs more current activity or more future capacity building. When rates are low, the signal is to spend and invest more now. When rates are high, the signal is to save more and defer spending. The signals guide resource allocation across time. Asset prices respond to interest rate changes. Assets are valuable because they generate future income. The present value of future income depends on the discount rate used. Interest rates serve as discount rates. Lower rates make future income more valuable in present terms. Asset prices rise to reflect the increased present value. Higher rates have the opposite effect. Future income is worth less today, so asset prices fall. The relationship is mathematical, but the effects are economically significant. Rising asset prices create wealth gains. Those who own assets feel richer. They may spend more based on increased wealth. Falling asset prices create wealth losses. Owners feel poorer and may cut spending. The wealth effects transmit rate changes to consumption behavior. Stock markets are particularly sensitive to rate changes. Stock prices reflect discounted future earnings. Rate changes alter the discount factor. Stock prices move accordingly. Real estate markets also respond strongly. Property values depend on expected rental income or housing services. Discounting at different rates produces different valuations. Rate movements cause property price fluctuations. Bond markets move immediately with rate changes, by definition. Bond prices and interest rates are inversely related. A rate increase means bond prices fall. A rate decrease means bond prices rise. These asset price movements affect household and business balance sheets. Balance sheet changes influence spending capacity and confidence. The effects spread through the economy. Currency markets respond to interest rate differences between countries. Higher rates in one country attract capital from other countries. The capital inflow increases demand for that currency. The currency appreciates. Currency appreciation makes imports cheaper and exports more expensive. This affects trade balances. Changes in trade alter production and employment in various sectors. The currency channel means interest rates affect international competitiveness. A country with higher rates may see its export sector struggle. A country with lower rates may see exports become more competitive. Banks operate at the center of interest rate transmission. They borrow at some rates and lend at others. The spread between borrowing and lending rates provides their income. When central banks change policy rates, bank funding costs change. Banks typically adjust their lending rates in response. The adjustment transmits policy changes to borrowers throughout the economy. But the transmission is not mechanical. Banks consider many factors when setting rates. Their own financial position affects their willingness to lend. Competitive pressures influence pricing. Regulatory requirements constrain actions. Sometimes rate changes transmit fully and quickly. Policy rate cuts lead to proportional lending rate cuts. Borrowers benefit immediately. Other times transmission is partial or delayed. Banks may not pass through the full rate change. Lending rates may adjust slowly. The policy impact is muted. The variability in transmission affects policy effectiveness. When transmission works well, policy can influence the economy as intended. When transmission is impaired, policy has less impact. Financial conditions can interfere with transmission. During crises, banks may raise lending rates even as policy rates fall. They do this to protect against increased risk. The defensive behavior prevents stimulus from reaching borrowers. Such impairment can make low rates ineffective. The intended stimulus fails to materialize. The economy remains weak despite accommodative policy. Expectations play crucial roles in how rates function. Current rates incorporate expectations about future rates. If people expect rates to rise, they may act preemptively. They lock in current low rates before increases occur. This expectation-driven behavior can amplify rate effects. A rate cut may stimulate more if people expect rates to rise later. They rush to take advantage of temporarily low rates. Conversely, if rate cuts are expected to continue, people may wait. They anticipate even lower rates ahead and defer borrowing. The current cut has less stimulative effect. Central banks try to manage expectations through communication. They signal future policy intentions. They explain the rationale for decisions. They provide guidance about likely paths. The communication affects how current rate levels influence behavior. Clear guidance can enhance policy effectiveness. Confusing signals can reduce impact or create unintended effects. All these daily functions of interest rates occur simultaneously. Households make consumption choices influenced by borrowing costs. Businesses make investment decisions based on hurdle rates. Savers allocate funds based on available returns. Asset prices adjust to rate changes. Currency values shift with rate differentials. Banks transmit policy through lending rate changes. Expectations shape responses to rate levels. The simultaneous operation of multiple channels creates complexity. Effects may reinforce each other or offset each other. The net impact depends on specific circumstances. Rate changes that would be stimulative in one context might be ineffective in another. Rate increases that would cool overheating in one situation might trigger crisis in another. Understanding context is essential to predicting effects. The daily functioning of interest rates is what gives them power over economic stability. Through continuous influence on decisions across the economy, rates shape aggregate outcomes. They can moderate fluctuations or amplify them depending on their level and movement. But rates do not function in isolation from other economic systems. Their effects depend on how they interact with other forces and institutions. Interest rates interact extensively with other economic systems. These interactions determine whether rates stabilize or destabilize. The most fundamental interaction is with inflation. Inflation erodes money's purchasing power over time. Interest rates must account for this erosion. When inflation rises, lenders demand higher nominal rates to maintain real returns. Borrowers are willing to pay higher nominal rates because they repay with depreciated money. Nominal rates rise with inflation. This adjustment helps stabilize the economy. Higher rates cool demand by making borrowing more expensive. Cooling demand helps reduce inflationary pressure. The feedback creates a dampening effect. But the relationship can work in destabilizing ways. If inflation expectations become unmoored, rates may rise sharply. Sharp rate increases can cause severe economic contraction. The contraction may overshoot what is needed for stability. If central banks fail to raise rates enough as inflation rises, real rates become negative. Negative real rates encourage borrowing and spending. This adds to inflationary pressure. The feedback becomes reinforcing rather than dampening. Interest rates interact with employment through multiple channels. Lower rates stimulate demand, which supports employment. Higher rates restrain demand, which reduces employment. The relationship creates a policy trade-off. Keeping rates low supports jobs but risks inflation. Raising rates to control inflation may increase unemployment. Central banks try to balance these considerations. They aim for rates that support maximum employment consistent with stable prices. Finding the right balance is difficult and imperfect. Sometimes the trade-off seems favorable. The economy can run hot with low unemployment and low inflation. Rates can stay relatively low while supporting strong employment. Other times the trade-off is harsh. High inflation requires rate increases that cause unemployment. Achieving price stability demands economic pain. The interaction between rates and employment becomes destabilizing. Interest rates interact with government fiscal policy through debt service costs. Governments borrow substantial sums. They must pay interest on outstanding debt. When rates are low, debt service costs are manageable. Governments can maintain or expand spending without financial stress. Fiscal policy remains flexible. When rates rise, debt service costs increase. More government revenue goes to interest payments. Less remains for other purposes. Fiscal policy becomes constrained. High debt levels amplify this effect. Countries with large debts are highly sensitive to rate changes. Rate increases can make debt unsustainable. This creates risk of fiscal crisis. The interaction between rates and fiscal positions can be stabilizing or destabilizing. Low rates help governments manage debt, supporting stability. But prolonged low rates may encourage excessive borrowing. When rates eventually rise, accumulated debt becomes problematic. Interest rates interact with financial system stability through bank profitability and risk-taking. Banks profit from the spread between borrowing and lending rates. Changes in rate levels and structure affect profitability. Very low rates compress spreads. Banks struggle to maintain profits. They may take more risks to generate returns. Increased risk-taking can lead to financial instability. Rising rates can initially boost bank profits, but rapid rate increases can cause asset quality deterioration. Borrowers struggle with higher debt service. Defaults increase. Banks suffer losses. The interaction creates challenging dynamics. Rates too low for too long encourage risky behavior. Rates rising too fast trigger financial stress. Finding a path that maintains stability is difficult. Interest rates interact with housing markets powerfully. Most home purchases involve mortgages. Mortgage rates determine affordability. Low rates make housing more affordable. More people can qualify for mortgages. Demand for housing rises. Prices increase. Rising prices create wealth effects for homeowners. They may borrow against appreciated home values. The borrowing finances additional spending. The economy receives stimulus. High rates reduce housing affordability. Fewer people can qualify for mortgages. Demand weakens. Prices stabilize or fall. Falling prices reverse the wealth effects. Homeowners feel poorer. They reduce spending. The economy faces headwinds. The housing rate interaction can be highly destabilizing. Rate cuts can inflate housing bubbles. Rate increases can burst them. The boom-bust cycle causes economic volatility. Interest rates interact with pension funds and insurance companies. These institutions have long-term obligations to beneficiaries. They invest to generate returns to meet these obligations. Low rates make it harder to generate required returns. Institutions may take more risk or struggle to meet obligations. The strain affects financial stability. Very low rates also affect pension funding status. Obligations are discounted at prevailing rates. Lower rates increase the present value of obligations. Funding gaps widen. Rising rates can improve funding status, but they also cause losses on existing bond holdings. The transition to higher rates can be painful. Interest rates interact with commodity markets. Commodities can be stored. Storage has costs including financing costs related to interest rates. Lower rates reduce storage costs. This encourages holding inventory. Reduced supply available for immediate use can raise spot prices. Higher rates increase storage costs. This discourages inventory holding. More supply becomes available immediately. Spot prices may fall. The interaction between rates and commodity prices affects inflation. Changes in food and energy costs feed into overall price levels. Rate effects on commodities create indirect inflation effects. Interest rates interact with emerging market economies through capital flows. When rates in developed countries are low, capital seeks higher returns elsewhere. Emerging markets receive substantial inflows. The inflows appreciate emerging market currencies. They fuel lending and asset price increases. Economic activity accelerates. When developed country rates rise, capital flows reverse. Emerging market currencies depreciate. Lending conditions tighten. Asset prices fall. Economic stress emerges. The capital flow channel makes emerging markets vulnerable to developed country rate changes. Policies in large economies create spillovers to smaller ones. The international transmission can be destabilizing. Interest rates interact with corporate debt levels. Low rates encourage corporate borrowing. Companies finance buybacks, acquisitions, and expansions with cheap debt. Leverage increases. Increased leverage makes companies vulnerable to rate increases. Higher debt service costs strain cash flows. Some companies may face distress. The corporate sector becomes fragile. Interest rates interact with inequality through various channels. Asset owners benefit from low rates through price appreciation. Those without assets miss these gains. Wealth inequality can increase. Savers relying on interest income suffer from low rates. Retirees on fixed incomes face difficulties. The distributional effects can be significant. All these interactions create a complex web. Rate changes trigger effects across multiple systems simultaneously. The effects can reinforce or offset each other. Sometimes the interactions produce stability. Multiple feedback loops dampen fluctuations. The system self-corrects. Other times interactions amplify instability. Reinforcing feedbacks create spirals. Problems in one area spread to others. Understanding whether rates stabilize or destabilize requires examining these interactions. The effects depend on context and configuration. When systems are resilient and well-balanced, rates contribute to stability. When systems are fragile and unbalanced, rates can trigger instability. The interactions become especially important during periods of stress. Interest rates face their greatest tests during periods of economic or financial stress. How they respond determines whether they stabilize or destabilize. During economic downturns, central banks typically lower rates. The goal is to stimulate borrowing and spending. The stimulus should support employment and prevent deflation. When rate cuts work as intended, they help stabilize the economy. Lower borrowing costs encourage consumer spending and business investment. Demand recovers. The downturn is moderated. But rate cuts may fail to stimulate if conditions are too stressed. Banks may refuse to lend despite low policy rates. Credit spreads may widen, offsetting policy rate reductions. Borrowers may be unwilling to take on debt even at low rates. This transmission failure is called a credit crunch. Policy loses effectiveness. The economy remains weak despite accommodative rates. Alternative policy tools become necessary. During financial crises, interest rate dynamics become especially complex. Risk perceptions shift dramatically. Credit spreads can widen sharply. Lending freezes up. Central banks may cut policy rates aggressively, but market rates may not follow. The divergence indicates financial system dysfunction. Rates are not functioning normally. In severe crises, central banks may need to bypass normal rate transmission. They provide direct lending to markets. They purchase assets to affect longer-term rates. They take extraordinary actions beyond conventional rate policy. These interventions aim to restore normal rate functioning. Once credit flows resume, conventional rate policy can work again. Stability depends on repairing the transmission mechanism. Very low rates maintained for extended periods create their own stresses. Financial institutions struggle with compressed margins. Savers receive minimal returns. Asset prices may inflate beyond sustainable levels. The prolonged low-rate environment encourages risk-taking. Investors reach for yield in riskier assets. Companies take on excessive leverage. Financial vulnerabilities accumulate. When rates eventually rise, these vulnerabilities are exposed. Asset prices correct. Highly leveraged entities face distress. The adjustment can be disruptive. The challenge is that keeping rates low risks future instability. But raising rates too soon can abort recovery. The timing dilemma creates policy difficulty. Rapid rate increases can trigger instability even in otherwise healthy economies. Borrowers face sudden increases in debt service costs. Some cannot adjust quickly enough. Defaults increase. Asset prices can fall sharply when rates rise fast. The wealth destruction affects spending. Economic activity slows. The slowdown can become self-reinforcing. Historical episodes show the destabilizing potential of rate movements. Rapid rate increases have preceded many recessions. The monetary tightening slows the economy more than intended. The overshoot creates instability. But maintaining stable rates can also be destabilizing if conditions warrant change. Failing to raise rates when inflation emerges allows imbalances to build. Eventually, larger rate increases become necessary. The delayed adjustment is more disruptive. Interest rates interact with debt levels to create stability or instability. Manageable debt becomes unmanageable when rates rise. Countries, companies, or households can move from solvent to insolvent. High global debt levels make the world economy sensitive to rate changes. Rate increases that would have been modest disruptions in low-debt environments become major shocks. The debt amplifies rate effects. Currency crises can result from interest rate dynamics. If rates in one country fall far below rates elsewhere, capital flees. The currency collapses. The collapse creates inflation and instability. Defending the currency requires raising rates. But higher rates depress the economy. The choice between currency defense and economic support is difficult. Emerging markets have faced these dilemmas repeatedly. Rate decisions become choices between bad and worse outcomes. The instability spreads through international channels. Interest rate policy can itself become a source of instability if credibility is lost. If central banks appear incompetent or politically captured, expectations become unanchored. Rate changes fail to have expected effects. The loss of credibility is destabilizing. Maintaining credibility requires consistent policy guided by clear principles. Central banks must be seen as competent and independent. They must communicate clearly and follow through on commitments. But credibility can be lost quickly through mistakes or political pressure. Once lost, it is hard to regain. The loss reduces policy effectiveness when it is most needed. Interest rates face limits that create stability challenges. Rates cannot fall much below zero. The zero lower bound constrains how much stimulus policy can provide. When rates hit this bound, conventional policy is exhausted. Central banks must use unconventional tools. The effectiveness of these tools is uncertain. The zero bound makes severe downturns harder to fight. Insufficient stimulus means longer, deeper recessions. The constraint is inherently destabilizing. Some countries have experimented with negative rates. Banks are charged for holding reserves. The hope is that this encourages lending. But negative rates create their own problems. They squeeze bank profitability severely. They may encourage cash hoarding rather than lending. The effects are uncertain and potentially destabilizing. Very high rates also create stability challenges. When rates must rise far to combat inflation, economic damage is severe. Recessions may be needed to break inflation psychology. The cost is high unemployment. The trade-off between inflation and employment becomes acute. Achieving price stability requires accepting economic weakness. The process is painful and politically difficult. Historical episodes of very high rates show the destabilizing potential. Double-digit rates have caused severe recession. Business and household failures have cascaded. Financial systems have come under strain. Yet sometimes the harsh medicine is necessary. Inflation left unchecked creates its own severe instability. The difficult choice is between pains now and worse problems later. Interest rate policy operates with long and variable lags. Actions taken today affect the economy months or years later. The delay creates challenges for stability. Policy must be forward-looking rather than reactive. But forecasting is imperfect. Mistakes are inevitable. By the time policy effects appear, conditions may have changed. Stimulus applied to a weak economy may hit when strength has returned. Restraint applied to overheating may hit during cooling. The timing problems can turn stabilizing intentions into destabilizing outcomes. Well-intentioned policy becomes procyclical rather than countercyclical. Fluctuations are amplified rather than dampened. Multiple central banks operating independently can create coordination problems. Rate changes in one country affect others through trade and capital flows. What is appropriate policy for one may be inappropriate for others. Lack of coordination can create instability. Competitive devaluations may result. Currency volatility increases. Trade relations strain. But coordination is difficult to achieve. Countries face different conditions and priorities. Domestic considerations dominate policy choices. International effects are secondary. Interest rates are supposed to help balance saving and investment. When saving exceeds investment opportunities, rates should fall. When investment demand exceeds available saving, rates should rise. This balancing function promotes stability by matching supply and demand for funds. It prevents extreme shortages or surpluses of capital. But the balance can break down. Global savings gluts can push rates to very low levels. Investment may not respond despite cheap funding. The imbalance persists. Or investment booms may overwhelm available saving. Rates rise but borrowing continues. Unsustainable debt accumulates. Crisis eventually follows. When the balancing mechanism fails, rates no longer stabilize. They may remain at levels that perpetuate imbalances. The instability builds until correction forces adjustment. Financial innovation can interfere with how rates function. New instruments may reduce rate sensitivity. Complex derivatives may hide risks. The transmission of policy becomes less predictable. Innovation can also amplify rate effects. Leverage embedded in new instruments magnifies gains and losses. Small rate changes create large impacts. Instability increases. Regulation attempts to limit destabilizing uses of innovation. But regulation often lags behind financial creativity. By the time risks are recognized and addressed, damage may be done. The interaction between innovation and regulation creates ongoing challenges. Finding the right balance between allowing beneficial innovation and preventing destabilizing excesses is difficult. Despite all these challenges and potential sources of instability, interest rates often do contribute to stability. Most of the time, rate adjustments help moderate economic fluctuations. Central banks have learned from past mistakes. Policy frameworks have improved. But the potential for destabilization remains. When conditions are stressed, when debt is high, when errors accumulate, rates can amplify rather than dampen problems. Understanding when rates stabilize versus destabilize requires examining context. The same rate level can be appropriate or inappropriate depending on circumstances. The same rate change can help or harm depending on conditions. There is no simple formula. No mechanical rule guarantees stability. Judgment based on understanding of complex interactions is necessary. The challenge is that understanding is always incomplete. Economies are complex adaptive systems. They evolve and surprise. What worked before may not work again. This fundamental uncertainty means interest rate policy will always involve risk. The risk of error cannot be eliminated. It can only be managed through careful analysis, clear communication, and readiness to adjust when conditions change. With this understanding of stress and stability, the full picture of how interest rates affect the world has been explored. The concepts deserve careful review to allow deeper comprehension. Interest rates are prices that influence nearly every economic decision. They represent the cost of borrowing and the return from lending. They reflect time preferences, risk assessment, and expectations about the future. Understanding interest rates means recognizing their multiple dimensions and effects. Interest rates emerged from the basic human tendency to value present resources more than future resources. This time preference created demand for mechanisms to transfer resources across time. Borrowing and lending met this need. Interest became the compensation that made the transfers mutually beneficial. Over time, institutions developed to facilitate borrowing and lending at scale. Banks intermediated between savers and borrowers. Financial markets created trading in debt instruments. Central banks emerged to influence short-term rates and manage monetary systems. The formation of interest rates involves many forces and mechanisms. Supply and demand for funds influences rate levels. Risk assessments affect rate structures across different borrowers and instruments. Expectations about future inflation and growth shape current rates. Central bank policies provide anchors for short-term rates. Market trading determines longer-term rates and credit spreads. International capital flows affect rate relationships across countries. All these elements interact to produce the rates observed at any moment. The formation process is continuous and dynamic. Rates constantly adjust to changing conditions and information. No single authority controls all aspects of rate determination. The daily functioning of interest rates occurs through influences on decisions. Households decide whether to borrow for purchases based on rates. Businesses decide whether to invest in projects based on hurdle rates. Savers allocate funds based on available returns. Asset prices adjust to reflect discounting of future cash flows at prevailing rates. Currency values respond to rate differentials between countries. Banks transmit policy rate changes through adjustments in lending rates. All these channels operate simultaneously. The collective effect shapes aggregate economic activity. Lower rates generally stimulate demand and encourage risk-taking. Higher rates generally restrain demand and encourage caution. The influences extend beyond immediate effects to shape long-term trajectories. Through investment decisions, rates affect capital accumulation and productivity. Through saving decisions, rates influence resource availability for future use. Through asset price effects, rates alter wealth distributions and confidence. Interest rates interact extensively with other economic systems. They connect to inflation through adjustments that maintain real returns. They affect employment through demand effects on production and hiring. They influence government fiscal positions through debt service costs. They shape financial system stability through impacts on profitability and risk-taking. They drive housing market dynamics through mortgage affordability effects. They affect pension funds and insurance companies through return generation challenges. They influence commodity markets through storage cost channels. They impact emerging markets through capital flow reversals. They shape corporate leverage and vulnerability. They affect inequality through differential impacts on asset owners and savers. All these interactions create complex webs of causation. Effects in one area ripple to others. The ripples can reinforce or offset each other. Whether rates stabilize or destabilize depends on how these interactions play out. During periods of stress, interest rate dynamics become particularly important. Rate cuts aim to support economies during downturns. But cuts may fail to stimulate if credit transmission is impaired. Very low rates maintained too long can encourage excessive risk-taking. The accumulated vulnerabilities may eventually cause instability. Rapid rate increases can trigger financial distress and economic contraction. But delayed rate increases may allow worse imbalances to develop. High debt levels amplify the impacts of rate changes. What would be modest adjustments in low-debt contexts become major shocks. Policy must navigate between competing risks. Acting too forcefully or too tentatively both carry dangers. The timing of policy changes matters greatly, but is hard to judge correctly. Long lags between actions and effects create coordination challenges. Credibility of policy institutions affects whether rate changes have intended effects. Loss of credibility reduces policy effectiveness when it is most needed. Interest rates face limits that constrain their use. The zero lower bound restricts how much conventional stimulus can be provided. Very high rates needed to fight inflation cause severe economic pain. The constraints mean rates cannot solve all stability problems. Other policy tools may be needed to complement rate adjustments. Understanding interest rates reveals them as powerful but imperfect tools. They influence economic behavior through multiple channels. They connect present decisions to future outcomes. They link domestic economies to the global system. When used skillfully in favorable conditions, they help maintain stability. They moderate fluctuations through feedback effects. They balance competing forces toward sustainable outcomes. But in difficult conditions or when used poorly, they can destabilize. They can amplify problems through reinforcing feedback. They can trigger crises through excessive or mistimed adjustments. The difference between stabilizing and destabilizing depends on many factors. The state of the economy and financial system matters. The level and structure of debt matters. The credibility and skill of policymakers matters. The alignment of expectations matters. The international context matters. No simple rule determines whether rates will stabilize or destabilize. The effects emerge from complex interactions in specific contexts. Understanding requires recognizing both the power and limitations of interest rates. They are central to economic functioning, but not omnipotent. They affect but do not fully control economic outcomes. They transmit policy, but the transmission is imperfect and variable. Interest rates represent a key example of how economic systems manage time and uncertainty. They price the difference between present and future. They compensate for risk in an uncertain world. They aggregate information about conditions and expectations. They provide signals that coordinate decentralized decisions. In doing all this, they become mechanisms through which stability or instability emerges. The emergence depends on the configuration of countless factors. Sometimes the factors align to support stability. Feedback loops dampen rather than amplify disturbances. The system self-corrects toward balance. Other times factors combine to create instability. Feedback loops reinforce deviations from balance. Small disturbances grow into large disruptions. The transition between stable and unstable states can occur gradually or suddenly. Warning signs may appear in advance or problems may emerge without apparent precursors. The inherent complexity and uncertainty make the system unpredictable in detail. Yet certain general patterns recur across different episodes and contexts. Prolonged low rates tend to encourage leverage and risk-taking. Sharp rate increases tend to expose vulnerabilities and trigger corrections. Very high rates tend to cause recessions and financial stress. Rates maintained far from levels warranted by fundamentals tend to create imbalances. These patterns provide some guidance, but no precise predictions. Each situation has unique features that affect outcomes. Understanding general patterns must be combined with careful analysis of specific conditions. The role of interest rates in stabilizing or destabilizing the world remains a central question in economics. The question has no final answer because circumstances keep changing. What stabilizes in one era may destabilize in another. What works in one country may fail in another. The ongoing challenge is adapting understanding and policy to evolving realities. This requires humility about the limits of knowledge. It requires flexibility to adjust when conditions change. It requires learning from experience while recognizing that past lessons may not fully apply to new situations. Interest rates will continue to play crucial roles in economic systems. They will continue to influence decisions across all levels of economic activity. They will continue to interact with other systems in complex ways. They will continue to have potential for both stabilizing and destabilizing effects. Managing this potential is one of the central challenges in economic policy. The management is never complete or perfect. But understanding the mechanisms helps improve outcomes over time. Recognizing how rates work, what influences them, how they transmit through the economy, and how they interact with other forces provides foundation for better policy. The exploration of interest rates reveals them as essential but complicated elements of economic life. They are prices with far-reaching effects. They are tools with power to help or harm. They are signals carrying information about present and future. They are mechanisms linking individual decisions to collective outcomes. Understanding interest rates means understanding a crucial dimension of how economies function. How resources are allocated across time. How risk is priced and managed. How expectations shape current behavior. How stability emerges or breaks down. This is why interest rates stabilize or destabilize the world. Through their multiple influences on decisions, interactions with other systems, and responses to stress. The effects are powerful, pervasive, and consequential. Interest rates quietly shape economic outcomes for individuals, businesses, and nations. Understanding this shaping is understanding a fundamental force in modern economic life.